physical market or a virtual market. Some of the physical markets that you might know is a mall, a flea market, right? You meet people, you see them, you see the product, and you feel it, you touch it, and you sell it or you buy it. And then there's the virtual market, which is the market that I interact with on a daily basis. That is the stock market, right? I use, now some of the popular markets that are popular in North America, being the NASDAQ, I'll write that down for you guys. There's the NASDAQ. There's the New York Stock Exchange, NYSE for short, it's the acronym for it. And in Canada, we have our own market, it's the Toronto Stock Exchange, the TSX. Now, these are all different markets that have securities, equities, futures, and a number of different products that you can trade and profit and benefit from. Now, what are all these things? We'll get into that in just a moment. So, what's an equity? An equity is essentially a stake, a share, a stake, a piece of a company that you own. That's essentially an equity that you can own. That's an equity. It's a piece of a company. If you have a fish, you own a fish, you go to tuna, the fish is cut up into 100 pieces and you give it to all 100 of your friends, you all own a piece of that fish. You own a stake in that fish. We'll save questions for the end. That's an equity, that's a stake. That's essentially a metaphorical share in that fish. So same thing for a company. If a company has 1 million shares, 1 million pieces, and each piece is valued at $1, that company is worth how much? $1 million. That's the market capitalization of that company. Now, the stock market and these markets, they facilitate the transaction of that company, of all these companies, right? They facilitate you to have the ability to buy and sell these stakes, these shares in these companies. That's all that these markets provide you for, right? Now, who are the players in the market? You have to know your enemy if you ever want to hope to defeat them, right? Sun Tzu says that in the Art of War. Now, we're going to get into that. Who are the players? There are brokers. There's market makers. And of course, there's institutions. / large funds. And there are retail traders, like me and you. Retail trader. Okay, probably rewrite that at some point, but you guys get it. There's brokers, there's market makers, there's institutions, large funds, and retail traders. Now, what role do these guys play in the market? Brokers facilitate the trades. You open up an account with a broker, and that's how you actually engage in the market. That's how you can trade. There's various brokers. There's Questrade. There's WealthSmart. WealthSmart has a halal fund, I'm sure some of you are aware of. And that's exactly, they facilitate the trades. They see the trades and they facilitate it. That's what a broker does. And there's the market makers. All you really need to know about them is they facilitate liquidity for the market. They add liquidity to the market. Now, what does liquidity mean? That just means how quickly your trades go through and they are executed, your buys and your sells. What are institutions and large funds, and how do they affect the market? Well, they have a lot of pull. Now, all these players actually, they all are people and entities that we are playing against. They all have huge pull in the market. They have billions of dollars that they can move the market themselves, right? They can dump a few billion into a company and move that price and profit from it. So they have to actually disclaim when they're buying into a company in a large amount, for example. So it's not too unfair for the rest of us. That's what institutions and large funds have to do. And retail traders, it's just me and you. We're just trading every day. And we're just playing against these other players and playing against everyone else in the market. That's retail trader. And like I said, it's key to understand the various players and their roles because of their pull in the market. Because not only can they leverage their positions and move certain prices against you, they have the power to technically manipulate it in that way as well. They can hide market orders with iceberg orders. We won't really get into all of that, but there's different things they can do. They have a lot of power. And let's face it, there's also some degree of insider trading that we don't really get into. So there's all kinds of advantages that it's a little gray area. So for the bigger players, right? So these are who you're up against when you're trading in the market, when you're engaging in the market. Banks, institutions, large hedge funds, etc. And also your broker, a lot of people don't know this, but your broker doesn't necessarily want you to win, per se, right? Your broker actually sees orders, and how they make money is placing bets against you, because most traders lose. So it only makes sense statistically that if you place a bet against the loser, then you're going to be a winner, right? It's just something to be aware of. They're not necessarily your friend, it's just something to know. Anyways, moving on. Does anyone understand what fundamental analysis is? Yes, sir in the front.
I'm just raising my hand because I understand.
Sure, okay. Alright, there's a few of you guys know what fundamental analysis is? Well, I'll go into it deeper anyways. Awesome. Alright, so fundamental analysis. Fundamental analysis looks at the ways of how to measure a company's intrinsic value. That's fundamental analysis. We're using different methods to understand the intrinsic value of a company. You're looking at the financial metrics, different ratios, how much cash they have, how much debt they're in, etc. This is how you determine fundamental analysis. There's various metrics that you go up against. That's fundamental analysis. To understand why this is priced at, let's say, this company X is priced at $5 a share, you use fundamental analysis to try to understand, is that a fair market value for that company, or is that overvalued, or is it undervalued? And knowing that is key to know how you can profit, because you profit in the difference. Now, what is technical analysis? Does anyone know what technical analysis is? I think some of you do, right? Because I talked about it. All right, technical analysis is essentially the study of trends, okay? And we're going to go into a few examples of technical analysis so that everyone has a deeper understanding of that. And fundamental analysis, we'll save that for a future seminar because I can do a whole seminar on it. It's a little complicated. There's a lot of finance involved in accounting. But, okay, so technical analysis. This is, I've had a sister who asked about Forex in the last seminar. So we're going to go into more technical analysis because Forex, in my opinion, it relies heavily on technical, but if you have a hybrid of fundamental, you stand to gain some alpha and some sort of edge over everyone else that doesn't understand the fundamental side of things. So anyway, so with technical analysis, you're studying trends, you're studying lines, you're studying the chart, you're studying how price movement moves, how price action takes place with response to volume, price, who's buying, selling, where is the pressure. That's technical analysis. Now we're going to get into a few examples of technical analysis. I'm going to do roughly 5, maybe we'll do more, because there's quite a bit of examples I can put on, but I'm going to touch upon just a few of the more important ones. I've had my entire wall full of charts in the past, so there's lots of examples I can give of technical analysis. So we're going to go through over a few of them and what they're called. They're all identified. So the first example used is called a flat top breakout pattern. Flat top. So this is a flat top breakout pattern. Imagine this line was a straight line. This is a bit crooked, but so price with respect to time moves forward, and essentially what happens is that this line here, every time price reaches this point, there's support from buyers. Buyers are moving in, causing it to jump, causing the price to jump. Now this can be applied to Forex as well as any kind of stock, company analysis. Cause the price to jump up, and then sellers move in. Buyers move in, sellers move in. Buyers move in, sellers move in, causing it to come down. Sellers are selling, buyers are buying. Now, what happens is that this entire area is buying pressure. Buyers are interested in purchasing the security at these prices, and it forms a pattern. It forms this flat top pattern. It's flat top because it's literally a straight line, creates a flat top. Literally, it's supposed to be straight like an iron. And against this sort of line movement here, that's what creates a flat top pattern. Now, why do these patterns exist? Don't ask me. They're just psychological. Buyers and sellers for the last 100 years or so have been noticing the same patterns and have been profiting from these patterns. It's how the market moves, literally. So when you notice this pattern, you can start to form a bias on which direction you believe it's going to go. It could either be a breakout when it breaks out of the pattern, or it could be a breakdown when it breaks down from the pattern. And this is where I like to use some fundamental analysis to form a bias on where be it a currency in Forex or a security on the stock exchange, which direction it's going. I start to form a bias when I see this pattern. And I form that bias through deep analysis of the fundamentals first, and then the technicals. Now the fundamentals, if it was, for example, a currency pair, I would look at the primary currency's economy, and I would determine the strength of the economy if there's some sort of news, a catalyst, to cause it to break out? Or is there a negative catalyst that would cause it to break down? And if it's a company, same thing. If there's some sort of positive news, like a dividend coming out, there's a rumor out there that dividends moving up on Microsoft, okay, then it's more likely to break out. It's all about, there is some sort of statistical probability to this, and that deals with the catalyst involved, the fundamentals behind the company, for example, how much cash they have, are they liquid, how much debt do they have, do they have low debt, do they have a lot of cash? Okay, well, your company's, it's a healthy company, right? They're having sales, they got good revenue. All these things, you have to be aware of them, you have to do your research before you decide to put your money into something. So, anyways, there's a flat top, buying pressure moves in, and sellers and buyers are meeting at this equilibrium point, but buyers are overpowering sellers, and that causes a breakout. Simple as that. That's the flat top breakout pattern. Now the second pattern we're going to talk about is the ascending triangle. And before we do, we're going to take a small break. And yeah, so everyone can go ahead and take a little intermission. We'll be back in 10 minutes.